Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, it seems that every time there is a pullback in the stock market, people are jumping in and buying the dip. We'll discuss that. Also, the way that the government collects data for its labor report is under fire. We'll have more on that. And are we now beginning to see the impact of the tariffs? It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill. Carrie's been a financial advisor for a couple of decades. She probably started at the age of 10 or so, and is the CEO of her own firm, Coghill Investment Strategies, and is consistently ranked among the top women advisors in the country. Next, we find Frank Ruscetti. Frank has a decade or two more than Carrie in advising clients through the firm he helped to establish, Harvest Financial. Frank now has his own alternative investment company, HF Management Company. Kim Forrest of Boca Capital Partners is also with us. Kim has successfully combined her background in finance and software engineering to help guide her clients. Kim is a frequent contributor to CNBC, Bloomberg, and also Fox Business. And there is one more spot at the table, and it is occupied by Michael Godwin. Michael is the Chief Investment Officer for Fergasso Financial Advisors and has an impressive background in finance and in investing. Thanks, my panel, once again for joining us. I hope you all are doing well.
Yes.
Yes, we are.
Okay, shake of the heads for those who are listening. They all said they're doing well. Okay. Now, the last time we gathered was July the 28th. That was quite a week with a Fed meeting, the tariffs kicking in, and the jobs report. And that report shook the market so much that all of the major indices dropped more than 2% that day. But this market continues to be resilient, and by the end of the following Friday, August the 8th, the Nasdaq had set a new all-time closing high, and the S&P 500 was within a point of setting a new closing high. So, Carrie, I will begin with you. Why is this market so resilient?
Well, I think the reality is that you have to look at have a broad perspective on economic data. And we had a really good second quarter GDP number at 3%, which was, pretty high, relatively speaking. And the market right now, I think the resiliency is coming from getting some clarity. The market does not like uncertainty. And as you know, this year has been all about tariffs and what's going to happen with the tariffs. And we're starting to get some clarity around that. And we continue to get some clarity around that. And I think the market likes that. Now, let's remember that it's August. And in August, we can see kind of a subdued reaction to a variety of different things because people are on vacation and so forth. And we know that we're headed into the two more volatile months of the year, and September and October. And I also think that one of the reasons why this market is as stable as it is, and counterintuitive, right? A bad jobs number means the potential for an interest rate cut. So as we go into September, a lot of people are expecting that we are going to see the Fed cut, which would be stimulative to the economy.
I'm going to pile on to that. I agree with you 100%, Carrie, and the numbers tell you why people think this is going to happen. I think if you look back in July, there was a very small chance of a rate cut in September, and it just went to something like 89%. And this is the crazy thing about the markets, is they are non-linear, we'll call it. Changes don't happen gradually, they happen suddenly. And I think people's lack of confidence in the employment numbers, even though we're having a relatively, good year so far for people that sell things like consulting services and food and, like the economy, even though that's going strong, looking into the future, the jobs numbers are really kind of appalling. We'll get to those later in this show, I'm sure. But that is what's behind the Fed's sudden change of heart, we'll say.
Add to that, we do have a slowing economy. I mean, you don't have to make reservations now at most restaurants, which has happened the last 2 or 3 months, so things have slowed down a little. That could be because it's summer, and that could be because the economy is slowing. It's hard to say. It's likely that interest rates, the odds makers on Wall Street have interest rate cut of 0.25% at 90% chance, which means if it doesn't happen, the market will collapse, and or they'll change the odds before then, and everyone will anticipate something else. And you've got a slowdown going on, and it's not a recession. It's just growing more slowly. And to me, these aren't bad things. I mean, this is a normal economy, and probably the next thing we all have to figure out is who AI winners and losers are going to be. Because there's going to be, Kim used the word before the show started, a bifurcation. This market's going to bifurcate. There's going to be companies that just aren't going to be able to exhibit the profit potential they've had historically because of AI. And there are companies whose profits will grow more rapidly because of AI. And it's our job to figure out the difference.
All right, I want to get to the AI thing in just a moment, but Michael, your thoughts on why this market's so resilient?
I mean, that's what I was going to bring up to begin with, Stacy's the resilience in the AI movement here. I think that's really the impetus as to why the market's done so well. The sheer amount of spend that's going into this, as Kim certainly knows and can talk about, is pretty astronomical. I was actually looking at NVIDIA today. NVIDIA is a $4.5 trillion company. That is not too far off from the entire market capitalization of the entire healthcare industry. So every single healthcare stock is about just over 5 trillion. So NVIDIA is nearing the entire market cap of all healthcare stocks, which is healthcare is a huge segment of the U.S. stock market. So we're just seeing the spend in these companies is astronomical. Once you get a slowdown or a pullback there, I think that's going to send the markets down, maybe not like recessionary levels here, but you're going to see a pretty big pullback, I think, once that happens.
All right, I've got a couple of things I want to bring up about this particular topic, and the first of which comes from a newspaper, a local newspaper, the Pittsburgh Post-Gazette. It has an article that food prices continue to increase. So that may be counter to what we've just been saying about prices going down or at least stabilizing. Also, from the Wall Street Journal, American companies are buying their own stocks at a record pace. Buybacks are expected to top $1.1 trillion in 2025, led by the big banks and the tech firms. And so there's speculation that is propping up the market at this point. Also, a new generation of buy-the-dip investors is propping up the market. Investors were told to fear the crash, and instead they learned to love the dip. And also that particular article goes on to say a lot of the people who are buying the dips were not investing at the time of 2008 or necessarily even in COVID. All they've seen is a rosy picture out there. So I want to get to the AI again in just a moment, but your guys' reaction to what I just said.
I think everything that you just said is true, and it's part of the equation. I think that the buybacks have been going on for decades. And, we've talked about this in the past where the volume of stocks available to buy has shrunk. So the markets are trading at a multiple we're not accustomed to because the supply is lower than it has historically been. Partly, everything's a little piece. These things aren't simple one answer questions. It's very multifaceted. Mike brought up 4 different things that the other 3 of us didn't even mention, and so and there's more.
I think the buyback narrative, and Kim can certainly talk about this probably better than I can, is these tech companies you mentioned, they issue so much stock to their employees as a part of their compensation package. So if they're issuing stock here, in order not to dilute other investors, they need to buy back some stock on their own end to sort of even that kind of out. So that's part of the narrative there too. And also they might think their company's a little bit undervalued, so they want to buy that back as well. In terms of the buying the dip, I was actually just looking at this the other day because I need to talk about this in a few days at a presentation. But we've had 7 of the last 8 pullbacks over the past decade 10% pullbacks have happened within a 1 to 2 to 3 month span, and we saw a quick snapback. The only time out of that 8 periods was 2022, where it was a prolonged downward year for that. So you're right. Once you see a quick downturn, the markets historically, at least over the past decade, have bounced back up. And if you have a dip in a non-recessionary period, I actually think it's an okay time to take advantage of that and buy it back. However, if it's in an environment where the economy really is starting to slip and you might be going into recession, this time might be different than what we've seen over the past 9-10 years or so.
I think that, first of all, I love what Frank said about the supply situation with the market. I think it's one of the more overlooked items when we hear people talk about multiples and historical multiples, meaning price earnings ratios, because you have a lot more demand with individual investors and 401k investors and less supply of stocks. The other thing I just want to say about the whole situation with AI and winners and losers, and I appreciate the comments at the beginning about how I haven't been around all that long, but unfortunately it's been a really long time. And I will say that experience matters. We have a playbook here, and it's called the internet bubble. So I think that when you look at what's going on in AI and some of these stocks, the internet bubble was a little more widespread and seemed to happen faster, but we'll see. So I do think that you have to be very cautious, very, very cautious of what you're paying for a company and the impact. Think about it. Think about companies that were impacted by, the smartphone, Eastman Kodak, like big name companies that just aren't around anymore. But then think of all the great companies that exist that weren't around back then. So they're like everyone has said, winners and losers, but we've been here before, actually.
Kim, I'll give it to you here, but I will do it this way, playing off of what Carrie just said. In Bloomberg this morning, there is an article about AI's downside, as it calls it, and it lists several companies that are already not doing well because of AI. Others will go up, and this goes for Frank here. Historical precedents abound for new technology wiping out industries. The telegraph gave way to telephones. Horsewhips and buggies were toppled by the automobile, and blockbusters eradication by Netflix exemplified the internet's disruption of the market. So take it away on that one.
Okay, where to begin? Actually, I had some stuff to say about the whole modeling of the markets, and I agree with everybody, but we'll save that for another time because now we're on AI. So in a similar article over the weekend, I can't tell you how much I love reading the Weekend Wall Street Journal. That just should show you what my whole thing is. But Peggy Noonan's article, it's an op-ed piece, and she's kind of the same kind of thing that the Bloomberg article is, only hers is more feelings oriented about what are we going to do with all these unemployed people. I had to make myself read this article because I was having conversations with my old AI computer science software people, and we were all underwhelmed with what ChatGPT rolled out as version 5. And when I was driving home on Friday morning from somewhere, I'm listening to Sam Altman talk about this, and he's talking about how the great forward motion that they've done in this model, which is underwhelming a lot of people, was because they made synthetic data. So what does that mean? They're making up stuff for it to learn from. And let's just set this. These models are learning from the internet. And I'm pretty sure not everything in the world is on the internet yet. And it's weighted in certain areas, whether it's true or not. This isn't even opinion. This is just the amount of data that's on there. So these models don't know everything. And I think this is what we're really missing, is that I don't believe that within a year or two, we're going to have massive layoffs of white collar workers. We may not have a lot of hiring because we're going to figure out, like, is this for real or not? But the accuracy is still very low. And the fact that it's being trained on the internet limits the data that it has. I think it's done wonderful things. Natural language processing is a beautiful thing, and people don't really want to type specialized phrases in to get answers, which are really websites that you have to go and look up. So we're getting some gains, but it's not this dramatic 2-year shift where we're going to have, Mad Max world with people rolling around downtown, out of a job and angry about it, right? Have I painted a picture for you?
Yep, you have. And to
Okay.
follow that up, there was also an article, I can't remember where it was, that I read over the weekend, that some think tank has already done a preliminary research on where AI is affecting jobs. And you're right. The people who are losing their jobs are not the ones that are affected by AI. It's just regular job losses that go along with the economy. So, all right, speaking of job losses, I want to turn to this subject, and Kim, I'll keep with you.
Oh boy.
The markets nosedived on August the 1st with the jobs report. It was not a great report, but can you help explain why a recalculation of previous jobs reports upset the market so much, and what does it mean moving forward?
Okay, let's start with how this is done, and I'm going to try to make this short so other people can actually talk. So the way the government calculates the job gains or losses in any month is it sends out 2 paper-based surveys in the mail. Like, I slowed down there because does that seem modern? No. One goes to consumers, that's or households, and one goes to businesses, that's the establishment survey. And what they try to do is true these up to each other and see how much more people are getting in pay, how many more jobs or less jobs are, on both sides of this. Now, probably for the past 10 years, but really in the last 3 years, there's been a lot of correction done every month. And the last 2 months were like this super correction. And you might ask yourself, why is this? Well, the honest truth is people just don't think it's important. They don't, survey recipients are throwing them away. This is analogous to the discovery that, people were actually working in a salt mine to process paper claims for government employees that want to retire. We need to update this with more appropriate data gathering other than, sending things in the mail. So that is why, it's just people aren't sending them back. So the people who do the survey, who compile this data, have to do a lot of educated guessing. And guess what? They've been guessing wrong. That's it. That's the answer.
What's always mystified me is that every company in the country that has an employee has to send, often electronically, a FICA payment at least every 90 days if they're very small, every 2 weeks if they're very large. And that FICA payment goes with copious records of how many people are working and who it's for and whose social security numbers they are. And I don't understand why somebody just can't sort that and come up with the number. I mean, it's there. They have the data. I don't understand why they don't use the real live data. But I'm not a tech person like you, Kim. I mean, I understand columnar pads where you actually foot them.
AI will take care of it in a couple of weeks, Greg. Don't worry. It will. I think the from the job numbers, I think the weaker employment gains since May were just a symptom of the spike in trade policy uncertainty. That's abated a little bit over the past few weeks or so. And then we obviously, as we all know, had a big U-turn in immigration. So I think that's why you saw the revision down. That wasn't really active layoffs, as Kim and Frank kind of talked about. But right now, I think right now, probably going forward, I think businesses are in a low hire and a low fire mindset. Right? I think Carrie pointed out at the beginning that companies are generating a lot of profits, so elevated profits are sustaining these payrolls. So there's no firing. But all the uncertainty that's going on, given government policies, higher tariff rates, et cetera, have caused many executives to just stay on hold, and there's now no hiring really going on.
Yeah, I think the point here is that you can't rely on any one data point for making your investment decisions, and you have to go into an analysis knowing that things are going to get revised. And in particular, the jobs numbers. I think if there's anything that came through with that revision, is that going forward, you really need to pay more attention to the revisions than to the first number that comes out. So we'll see, as I'm sure we are all aware, Trump fired the head of the
Bureau of Labor Statistics.
right. So
Labor management.
is that going to make it? Is that going to make a difference? Not right away. So, maybe someone new coming in there will, bring systems up to speed, and, maybe Frank can give that person a call and tell them that they should be following the FICA payments.
All right. Michael, most of you on this podcast have said European stocks have performed well. Having said that, here are some recent headlines over the weekend or so. Irish factory output slumped in June as exports to U.S. fell. German exports to U.S. fall for third straight month as industry slumps. Exports to the U.S. slid 2.1%, not part of the European market. But India's economy faces a bumpy road in face of steep Trump tariffs. So, are we now beginning to see the impact of these tariffs? And if so, what will it mean?
Yeah, I think we talked about this a little bit before. Many companies, at least here in the U.S., they accelerated their inventory purchases in late spring, I guess, right after the announcement of the tariffs, and I think that inventory has since been depleted, and now we're at the beginning stages of seeing, how these incoming tariffs will really impact the economy in future, and how these companies are going to, buy their inventory going forward. Now, what hasn't really played in the data, I don't think yet, Stacy, is in, what was that, 2 weeks ago or so, we got, a little bit more clarity regarding the tariff rate for the EU, the European Union, as, President Trump and the European Commission President, where they finalized a tariff of 15%, I think, on nearly all, European goods sold to the U.S. So that's certainly lower than the 30% that Trump initially threatened, but it's still certainly a tariff that's higher than was last year. I think it's too early to determine how big of an impact this will have across economies, but businesses will, I think, certainly operate better now that there's more clarity and certainty regarding the tariffs. But nevertheless, a tariff is a form of a tax, and I imagine there's going to be lingering effects as we move into the back half of the year. We saw the European stock market give back a little bit of the outperformance that it had in the beginning of the year over the past 3 months. But again, I think you're going to see a lot more. I think the next few months are going to be really telling, not only from an inflation standpoint, but how businesses are going to navigate this new regime.
I think tomorrow we're going to see another inflation number. That will be interesting. And Thursday, I think we're going to see a producer price index number, which will also be interesting. See if any of this has worked its way into the costs of things. It may still be a little early because these things have been delayed. And just as an aside and a point of humor, in my mind, there's a trade that's going on called the taco trade, it's an acronym for Trump always chickens out. TACO, and they're gambling on whether he's going to stay there or not. And this thing exists because he's flip-flopped so many times on this. Who's to say he won't do it again? Not me, for sure. I don't know what he's going to do next.
Yeah, I think that we're starting to get some clarity on that front, and some agreements are being reached. I think the taco trade was very relevant over the early part of the summer, but it seems as though these negotiations and these agreements coming through will be helpful. As far as European stocks, Yes, the inventory cycle is a big deal. And, the good news about the European stocks is that the valuations there were so much lower than they were in the US, so they really can sustain the growth that they have seen. And it's kind of a reset because now the trading relationships have changed. And what we see going on in Europe is really, okay, we're going to have this situation with the US, but how can we strengthen our relationships with other countries and improve trade with other countries? To Frank's point about inflation, and this is a really important one, the last series of inflation numbers that we received pointed a little bit higher. And this is going to be a very telling week because, Stacy, to your point about the resilience of the market and kind of relying on a potential interest rate cut, if we start to see inflation really reaccelerate, that's going to derail our hopes for a rate cut. So this is a very important week. And, we don't want to get into that period of stagflation.
To bring something up that I heard months ago, and I can't remember who said it, it may have been Powell. Somebody asked somebody in a position of knowledge if the choice comes down to, because the Fed has a dual mandate, maintain full employment, keep inflation down. If we get into this stagflation environment, which people are worried about, where we have unemployment rising and inflation rising, that's conflicting for the Fed as to which one they're going to protect. And whoever it was that was doing the speaking, it was too long ago for me to remember who it was, but I think it was Powell. He indicated he would lean towards full employment and be less concerned about inflation. So throw that into the mix to muddy the water.
Kim, you want to wrap it up for us today?
No, I think this is just an example of why markets are so interesting, because we get all this data, and it's really how we're going to deploy the money. And, recently more money has been sloshing across the pond into Europe because it was undervalued. And I don't know. I think commerce and value find a way. That's what I have to say. So I don't care where the company is. Make sure it has products that are valued and that they know who their client is, and they want to keep focusing on that client and creating new products to surprise and delight them. And I think in the long term, you're a winner. But in the short term, I don't know.
I have one more question, and that is in regards to the inflation numbers you say are coming out this week. Will those be revised as well as they do the labor numbers?
Yeah, they all get revised.
So is the method of doing the inflation numbers the same as it is for labor?
I know this. No, they actually send people out from the BLS to go, or whoever the organization is, to go and check prices. I read this years ago that somebody will go into a pet store and check out how much parakeets are this week. I kid you not. They have a whole basket of goods that they go out and actually physically survey. Now that seems old-fashioned, but guess what? That you're getting the data, and it's compiled the same month after month. So your parakeet prices, are they going up or down? I don't know. We're going to find out.
That would be very important around Christmas time for the
Yes.
12 days of Christmas, the prices for all of those things. All right, thank you so much. There's a topic we didn't get to. I'm going to bring it up the next time, and that is the word that the Trump administration may be looking to put an IPO out on Freddie Mac and Fannie Mae. Some people are calling this a huge deal if it happens. We'll bring that one up the next time we gather. But for right now, thank you for joining us. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. Right now, thanks again for joining us. We'll see you again in about 2 weeks for The Bull, the Bear, and You.